how to complete your homework exercise 11, 12, and 13, which I believe is part 2 homework. So these are just some similar problems in that. The first one, exercise 11, asks about the safety of creditors' claims. So if you're a finance major, you will do financial ratios. 2 of those ratios are the debt ratio and the interest coverage ratio. The debt ratio is computed as total liabilities divided by total assets, and the interest coverage ratio is computed by operating income divided by interest expense. So what I've done is pulled Apple's financial statements, and we're going to do them on Apple. We're simply going to compare 2016 to 2017. So if you pull up the balance sheet for Apple, you can see that its total liabilities are 241,272, and for 2016, 193,437. So that goes in the numerator. The total assets are found under total assets, 375,319 and 321,686. So if I compute my debt coverage ratio, I have my total assets divided by my total liabilities divided by my total assets. I have 64%. And so, trying to figure out what they ask you here. Okay, so what does this tell you? So this basically, if you remember the accounting equation, assets equals liabilities plus owner's equity, you know that your assets are financed either with debt or with owner's equity. So we know that 64% of our assets are financed with debt here, and last year 60% of our assets were financed with debt. So we have must have borrowed some money during this time period, what this ratio tells us. And so it's grown from 60 to 64%. This is considered, the higher this ratio, it's more risky because you have to pay down debt and you have to pay interest. Whereas owner's equity, you don't have to pay dividends, you don't have to pay back owner's investments. So this is just a measure of risk. What's good and bad varies from industry to industry, so you can make comparisons. So I would say they have got slightly more risky because they have more of their assets financed with debt. Doesn't mean it's bad, just means you have more of them financed with debt. The other one is also a measure of risk. Get my formula back in there. This one tells you kind of how easily they can pay their interest expense. So I'm going to pause this for a second. Okay, so if I go to the income statement, I can get their operating income, which is 61344 and 60024. And then I look for interest expense and I can't find it on here. When you get into more advanced classes, you'll figure out that it's going to be in this other income and expense, but notice it doesn't tell us interest. So what I do is I go search for the notes to the financial statements. Okay, so I've pulled it up on top of here. Back in the notes to the financial statements, I find note 3, consolidated financial statement details, and it gives me some details on property, plant, and equipment, other non-current liabilities, other income and expense. So this is what I'm looking for, what makes up that other income and expense, and underneath it I find interest expense. So I'll move my income statement there. Okay, so my interest expense is 2323 and 1456. So I take my operating income divided by my interest expense. And basically what this is telling me is how many times can my operating income pay for my interest expense. Last year I could pay it 41 times over. This year I could pay it 26 times over. And remember when I said it's gone from 60 to 64, they must have borrowed more money. Notice that that's reflected in the interest expense. So I, as a banker, you would look at this and you would decide that they have become a little bit more risky, although they can pay their interest expense 26 times over. So there's good chance that I will be getting my payment for interest back because I can pay it very well. So that's that one, and that's kind of how you analyze it. So if I were going to compare two companies, I would find out this is the riskier side because I have a larger percentage of my assets financed with debt, and I can't pay my interest quite as many times. Exercise 12 talks about a capital lease. So briefly to explain what those are, read this. Company A leases a car for 5 years for $1,000 per month. The lease term is 5 years. If this is considered an operating lease, I simply debit rent expense and I credit cash on a monthly basis for the lease. So it's $1,000 debit to rent expense and $1,000 credit to cash. However, if I told you that you're going to lease it for 5 years, and at the end of the 5 years that car becomes your own, and you could have walked off of the lot. So notice 5 years times 12 is 60 payments, so I'm paying $60,000 over the lease term for this. But I could have bought that car for $50,000. Did I really lease it? And the answer is no. I didn't lease it, I bought it. So it kind of follows the saying, a rose by any other name is still a rose. You can call it a lease, but you really bought that car. If you're going to lease it for 5 years and at the end of the 5 years it becomes your own, that is indeed a purchase. So how do I record this as a purchase? This is called a capital lease, and a capital lease is a lease that is not an operating lease. So this one's called operating, and this one is called a capital lease. Capital means to capitalize it, to add it to your cost of your assets. So I need to record my car. So I'm going to call it a leased car so I can just differentiate it on my balance sheet. And I know that generally when I borrow money for a car, I debit car and credit notes payable. Well, I'm going to call it a leased car, and I'm going to call it a capital lease obligation. Okay, and I also know that I paid $10,000 or $1,000 cash, so I'm going to record the entry on September 1st for it. So I'm going to credit cash because in essence I've made a payment on that car, and we'll assume that payment is all principal right now. So I know that's $1,000. This car could have been purchased for $50,000, or the present value of the lease payments is $50,000, and when you get into intermediate you'll do that. But basically what I've done with the $50,000 is remove the interest component out of the $1,000 a month, because whenever I pay off a loan I pay part principal, part interest. So I remove the interest, and that leased car is worth $50,000. Okay, so notice that my capital lease obligation then is the $49,000, because I have to have my debits equal my credits. So I have $50,000 credits, $50,000 debits. When I, this is not in your problem, but when I pay off the lease, I'm going to have interest expense, and I'm going to have my capital lease obligation, I'll abbreviate that, and I'm going to credit cash on a monthly basis. Okay, my credit's always going to be $1,000, and then I do computations to split the $1,000 between interest expense and capital lease obligation. But since this problem doesn't give you an interest rate, I can't do that. But I would take principal of $50,000 or $49,000 times rate times time to get my interest expense, and the rest of the $1,000 would be principal. But this problem doesn't ask about that. Okay, so this particular question, an operating lease does not appear on the balance sheet, but a capital lease obligation does, and this right there, that capital lease obligation. A capital lease obligation is a liability. The last one, exercise 13, talks about pension plans. Pension plans, how you get this $2 million for pension expense. So Company A had a pension expense of $2 million for the year that it funds that fully. Okay, what this means is they pay for the $2 million each year. You cannot determine the $2 million of pension expense. In fact, no accountant determines that. We hire a special person called an actuary who develops that estimate based on life expectancy, the rate of return that's going to do. So it's a pretty complicated computation, well above, quite frankly, any accountant that's even been out there for a long time. So it has to be done by an actuary. So we have pension expense of $2 million, so I'm just going to record that. And I need to put it in my balance sheet or my income statement because it's an expense of $2 million. Okay, the fact that this says it funds it fully means I'm going to credit cash. It's that simple. Okay, so there's my entry for that. Okay, my next entry is they also had post-retirement benefits. So if your company promises to pay your health care costs after retirement, you actually earn that as you work. So they need to, again, hire an actuary to develop an estimate of it. So I'm going to have post-retirement, pretend I spelled that right, benefits, expense. Pretend I spelled that word right also. So I have post-retirement benefits expense of $500,000. Again, it's just that simple. You cannot come up with the, move this over so my debits and credits are in the same. You cannot come up with that computation yourself. It has to be done by an actuary. Okay, so now notice that they fund 45% of that expense. So cash is simply going to be credited for 45% of that. So $225,000. And the rest of it goes to unfunded liability for post-retirement benefits. I'll just abbreviate that. So I need 500,000 minus that. And so your entry is just exactly that. So notice this is a liability. That's why it's in this chapter. That's a liability on your balance sheet. This is on your income statement. And notice that pension expense is fully funded. What that really means about this unfunded part, unfunded means if the company goes bankrupt, you become a creditor and you may or may not get this paid for. The fact that it's funded means the assets are there. Legal laws prevent companies from touching pension assets in bankruptcy. They're sort of a separate legal entity. But in this case, you might be guaranteed to get what's funded, but the unfunded portion, there's no guarantee. So it's just kind of up to the company.